Hey everyone, Dr. Barbara Eaton here and my pal, Jason Pivoz. So Jason and I have known each other for quite some time. He was a referral from my father, who I have the utmost respect for, and I know Jason's a big fan of my dad too. Jason is our family's accountant, and I don't even know over the years how many people I've referred to, but I'm always excited to be able to give them Jason's name because he does such a great job. So I just want to start this off by thanking Jason for jumping in and offering this service with me as I talk to more and more chiropractors, especially new chiropractors, this question about student loan forgiveness and just the IRS and like all of that stuff becomes very confusing. And I just encourage all of you, just like we encourage potential practice members to get expert advice. I would encourage all of you get expert advice. Don't believe the hearsay. Make sure that you actually, whoever you're getting advice from, knows your specific situation. And Jason's going to talk more about how important that is. As well, I will be giving you Jason's email address. Please be professional and recognize that he has given his time to all of us right now for free. So listen to this full recording as many times as you need to get the answers from here and follow up with any additional questions. But recognize that his time is of great value. I can't emphasize enough how important it is on your success team to have a awesome CPA. What are they called? If you're not a CPA, you're just a tax.
Oh, just an accountant, just a tax preparer.
Oh, tax preparer. They're not the same. So please don't think that a tax preparer is an accountant. It's kind of like, oh, I don't know, a massage therapist who does manipulation and a chiropractor. They're not the same. So at any rate, also you can post any of your questions below. Jason, as he always does, is incredibly prepared. So he's prepared a whole outline that we're going to be going through today. If you do have a question, pop it in the comment section. And if you don't want your name to appear on this broadcast, then just put on there like, please don't show, or you can also Facebook message me your question and I can get it over to Jason. So we're going to start with Jason's going to go through the overview. Any questions that you guys have sent me up until this point, I have forwarded them to him. And so he has prepared like an overview to answer those. Please also understand, just like we would never give specific chiropractic advice to an individual until we had a relationship with them and had an opportunity to get to know them better. This Facebook Live is not about answering your specific question because he doesn't know you. He doesn't know your exact situation. And just like we would never guess about someone's healthcare, Jason isn't going to guess about your financial situation, which I would hope that is all really valuable. And thanks to everyone who's saying hello, Dr. Karen, Dr. Olivia, and Dr. Ashley. Thanks and welcome for joining us. All right, Jason, so let's take it away. And thank you so much. I'm so appreciative of your willingness to join us and provide answers in this really crazy situation.
Well, you're very welcome, Barbara. Hopefully I can provide some useful information. I guess the biggest overriding comment that I can make at the very outset is I hope everyone who has a student loan has carefully read their loan documents. That is probably the single biggest thing that anybody can do is read and understand your loan documents. There are a lot of different loan programs out there. Some of those programs are public funded, some of them are all private based, and each of them have different repayment terms, borrowing terms, forgiveness terms. Some of the private party ones don't have any forgiveness terms. You could theoretically be paying those forever. However, most of the publicly backed ones do have some type of loan forgiveness program. Most of the loan forgiveness programs, many of them are based on income-based repayment, and those are typically carried out over a period of 20 to 25 years. So what the loan might say is might say something along the lines of, once you are at a point where you have graduated from school and you get to a point where you are repaying your loan, if you pay, it's sometimes 10%, sometimes up to 15% of your income on an annual basis toward the loan, for a period that can be anywhere from 20 years to 25 years, that the remainder of the loan can be forgiven, assuming you meet all the criteria. Now, that can be a very, very useful thing because obviously a lot of these loan balances get to be very, very high. The problem with most of the student loan forgiveness programs, though, is that effectively all but 2 of the programs actually generate taxable income when the loan balance is forgiven. So let me give you an example.
Hey, Jason, can you go back and just repeat that one more time? I'm taking notes too, and I just want to make sure I get it.
So there are really only a couple of programs out there. They're the Public Service Loan Forgiveness Program and the Student Loan Forgiveness for Teacher Program. Those are the only 2 programs right now under federal tax rules that the forgiveness is not taxable. Any other loan program that you're participating in, typically the debt forgiveness becomes taxable income in the year it's forgiven. What that means is that let's assume you started out with a $250,000 loan balance. You paid over a period of 20 years, you paid 10% of your income every year, and at the end of that period you had $100,000 of loan balance left. You would actually receive from the lender a Form 1099-C, which is for cancellation of indebtedness, and you would pay income taxes, both federal and state, on that money. So effectively, if you're by that point in the highest tax bracket, it would cost you, using average state tax rates, somewhere in the neighborhood of $45,000 to have your loan forgiven. So it's not free. It's not a get out of jail free card. The other things to consider here is your specific situation. Everyone's tax situation is a little bit different. Even if you have multiple partners in the same practice, you could potentially have different scenarios with the same dollar amount of student loan debt from partner to partner within a medical practice. And that is largely because people are married, people are not married, people have, some people might own rental properties, some people might own another outside business, some people might do moonlighting. All of those things can vary what your impact is going to be on repaying your loans. So your specific tax situation is very, very important. I will tell you that there is a marriage penalty associated with student loan repayment. Most student loan repayment programs, especially income-based loan repayment programs, will count a spouse's earnings in the income calculation with respect to calculating what your repayment needs to be. So if you're fresh out of school and you just got married and you're making $50,000 a year as a chiropractor, but you have a spouse that's making $150,000 a year at some other job because they've been out of school for a while, the $200,000 of total income between the 2 of you is what most likely would be used for the loan repayment calculation. Now, there is a way around this. In many of the repayment programs, if you file a separate tax return from your spouse, so married filing separate status, then you would not include your spouse's income in the loan repayment calculation. But there are some drawbacks to that. First of all, the student loan interest in a married filing separate return is not deductible. So you're losing a several $1,000 deduction by doing that. The second thing to keep in mind is that you are likely, as a household, going to end up with a substantially higher tax bill by filing separately as opposed to filing jointly. Now, I have seen that additional tax be $500. I've seen it be $5,000 or more dollars. So when you're trying to decide how you want to approach your loan repayment, you have to really look at not only the short-term picture, but you have to also look at the long-term picture. It does you no good to file a separate return and pay $5,000 or $6,000 of additional tax every year, losing your student loan interest deduction in the process, and then get debt forgiveness at the end and pay tax on it, if by the time you add up the lost tax deductions, the tax that you're paying on the cancellation of debt, plus the actual amount that you had to repay of the loan, if all of that adds up to more than what the loan balance would have been had you just gone ahead and repaid it and done your best to repay it as quickly as possible, then that really would be a much better solution. The problem is you also have to look at what's best for you today. So there are certain repayment programs where you can choose which path you want to go to. You can choose path A, B, or C, and then you can't change it. Well, if path C is the best long-term path, but over the next 3 years, it would effectively have you eating ramen noodles for every meal, that might not be realistic. So you might have to choose one of the other two paths, understanding that you're sacrificing some long-term dollars for some short-term comforts. So really understanding your tax position, your cash flow position, where you expect to be over the next few years is going to be very, very important. I have seen situations where people have come out of school, they've been practicing, they've been on income-based repayment, gotten married, had kids. Well, sometimes your schedule pre-kids and post-kids are not the same. This is true for both men and women, but we all know that especially for women, it can be even more true. When that happens, you may find that the amount of loan repayment that you would have, because your income goes down, the amount of loan repayment on an annual basis comes down dramatically. Now, that's a boon for you from a cash flow perspective in the short run, in that you're not repaying as much of the loan. However, please keep in mind that the interest keeps accumulating during that time period, even though you're not required to repay. And on top of that, you're going to end up with more of the loan to be forgiven at the end of the rainbow. What that means is that you've got more tax to pay at the end of the rainbow. Now, if you end up in a situation where, in my previous example, you had $100,000 of loan left, you ended up having to pay tax on that because it was forgiven. Let's say that number for federal purposes was $40,000 plus you had your state taxes. That $40,000, if you can't pay for it all at once, you can enter into an installment arrangement. Under $50,000 of balance, it's actually not very difficult to do with the IRS. You could do an online application. There's a very low user fee. It's quite easy. And as long as you can pay it over the course of a few years, there's no liens or levies filed. So that's great. The drawback, though, is that once again, now you have a different pull on your cash flow. Instead of having the loan repayment, now you've got a bill to the federal government. So you're effectively, if you've got a 25-year repayment plan and then you have debt forgiveness at the end, and then you have to pay off the tax bill over the course of, let's say, 5 years, you could really, if you finish school today, you could really be talking about it being 2047 by the time you're done with this. Now, I don't know about you, but I have no idea what things are going to be like in 2047. Yeah. So that's one other thing that you have to really keep in mind. Every administration has changed the rules on student loans and the way it's treated and the way the loans are written and modifications and all of that. So what the current administration is going to do, I have no idea. But we not only have to worry about today's administration, we have to try to predict what's going to happen 5 years down the road if a new president's elected, 12 years down the road, and potentially 20 years down the road. Now, most new laws don't impact contracts that are already in place. So a student loan contract that is already in place, if they change the overall rules on student loans, they typically would not phase it into people who already have loans if it's going to make things worse for them. They might make it better. They might make it better, but in many cases what they do is they say if your student loan occurred, if you were already on a repayment plan before this law came into play, whatever the date of that law is, then this doesn't impact you. However, if your repayment plan had not occurred yet, then you're going to receive the benefit of whatever this law is, pros and cons. The other thing to keep in mind here is that tax laws are typically changed prospectively. So if you're in a position where you think you're going to have your part of your loan forgiven, then at the end of the rainbow, they may very well make more of this forgivable and tax exempt. So if something like that happens, it could dramatically change the impact to you, the borrower, as you're moving forward. Unfortunately, that doesn't help you make a decision today. You can't make a decision based on what might happen. You have to make a decision based on what's currently out there.
Yeah, for sure. All right, so let me just clarify. So basically, I guess in a nutshell, is before you ever sign any loan documents, make sure you know what it is. And my advice, my dad has always taught me, pay for really like expert help, whether that's an attorney or like, that's why Jason's on my team. And I don't know about any of you, but like the amount of notes that I've taken pale in comparison to actually the questions, which is another reason why I'm super thankful I have Jason. Those of you who know me know that I paid off mine and my now ex-husband's in 3 years because I worked really hard, and had great advice and help. So suffice it to say, my encouragement to all of you watching, don't do this alone. Get expert advice, and please don't get lateral advice. And what I mean is, don't ask your peers who haven't gone to an expert, because I would assume your peers, just like I am your peer, I'm saying go to the expert because he is the guy who can give you advice about your situation. You know, most of the things that Jason was talking about just now too, they're going to be dependent. Like, are you married? Are you in a partnership? Are you like, there's so many different factors that it's not one answer fits all, just like in what we do in our practices. There isn't a magic bullet and there isn't an answer, but there is an answer for you. So you owe it to yourself and to your future family, your spouse, your legacy to have answers that are real to you. So one question that popped up here, Jason, I don't know if this is too narrow to answer in this kind of a fashion, but it's this. Is it true that the tax deductions per year are a max of $2,500 for student loans? Even when you pay more than that per year on your loan, you cannot deduct any more than $2,500 per year?
Yes, that is correct. And further to that too, there is a phase out point for that deduction, which I don't have the dollar amount memorized, but above a certain income level, it phases that deduction out. So you get to a certain point, if your income's high enough, you wouldn't qualify for the deduction at all.
Okay. And Martha, thanks for that question. Martha's saying, how do people get in touch? There you go. All right. So listen, I'm giving you Jason's email address, and I'm asking that you remember that he is a professional too. And just like we're happy to help people, there also has to be a level of responsibility as they ask us questions. And Jason doesn't run a charity in his office. He is obviously working just like we are. So please be respectful of his time. He's not saying don't ask him, and he didn't even ask me to say this. He actually probably would rather that I not say it, but he's my guy, and he's my accountant, and I'm going to protect his time. So please make sure you watch all of this several times so you get these questions answered, so that when you do reach out to him, it's very specific and you can get right to solutions. So, and listen, I live in Alaska, Jason's in Michigan. It doesn't matter if you live in another state, you can still use his services. I've lived in Alaska, I've lived in Tennessee, I've lived in Arizona, and Jason has been my accountant. I have clients from ocean to ocean who also use Jason's services. So don't let that impede you. All right, so then can we talk for a second, Jason, about IRS and peer-to-peer lending, and how does that play out? Like, so if you would, can you first just kind of give a broad overview of what is peer-to-peer lending, what is it in the context of accounting, IRS, and then how does that fit into student loans?
So peer-to-peer lending in general can be considered really any type of private lending, but peer-to-peer is normally a situation where specifically the individuals know each other. They're people in a similar vocation, similar situation. From the IRS's perspective, they don't care if you go to a bank and get a loan, or if you go to your neighbor and get a loan, or you go to your partner in your office and get a loan. For them, it's all treated the same. So from their perspective, whether it's legally considered a student loan or it's just some type of revolving line of credit. It may change how you get deductions for the interest you pay, but it would not change the ramifications for forgiveness of that debt. So it's very important to understand the IRS really categorizes loans in a few different ways.
I think they're okay. You'll have to repeat that part because you stopped.
Okay. The IRS really categorizes loans in a few different ways based upon what they're being used for. Mortgages are the best example of that. A mortgage is a private loan between an individual and a bank that is used specifically and secured by a residence. So the tax code gives you a specific set of deductions for being able to do that, for doing that, and it's a carve out in the tax code specifically. And every time they've tried to eliminate that, there have been the National Association of Realtors and the National Association of Bankers have said, no, don't get rid of that. We need to do it. It's effectively a subsidy for people to buy houses. Student loan interest is similar in that the government decided that it wanted to encourage people to go out and to go get an education. So they're giving a tax benefit for being able to go out and borrow that money. Now, if the loan is specifically a student loan, they typically have to have specific language in it in order to be considered a student loan and to be deductible as that. Any other loan that doesn't meet the very narrow criteria of a student loan would just be considered another personal loan. Now, personal loan interest is not deductible typically. You may be able to argue in certain cases that if it was for business purposes that it could be a business loan. That has deductibility. There's also something called an investment loan, which is used to invest in assets, whether that's securities or real estate or whatnot, and that's deductible in a different fashion. But once again, this goes back to understanding your loan documents, understanding what the loan is, what it's used for, who the issuer is, what the repayment terms are, because you have to be able to fit into that narrow window of being able to say, yes, this was a student loan first. That's the very first hurdle to being able to get any of the deductions or receive any benefit. Can you still hear me?
It stopped again for just a second. So it ended with, in order to get any benefit or deductions, and you stopped there.
Okay. In order to get any benefit or deductions, you really just need to make sure you understand your loan documents and make sure that it fits the mold of a student loan, especially if it's something that's coming from a non-traditional source like a peer-to-peer, because most of the public and private lenders, they have uniform loan documents.
Okay, so let's say somebody has, I don't know, like $150,000 in student loans, and let's just say, I think that the two options where it could be, that would be like through the federal government or a private thing even to begin with, specifically that they got through chiropractic college, right? They went to third floor and third floor finance said, here, I can get you all this money, just sign it. Right? So that sounds great. I think I'll sign up for all of these. So then I have $150,000 in student loans. Then I start repayment and it's crazy. And this lending company over here said, hey, we can give you $150,000 at, let's say, 3% interest instead of 9% interest. So you get that loan, you write a check to whoever you owe the student loan to. Now you have this other loan and it, with, I don't know, XYZ lending company. Perhaps, like kind of in general terms, that loan wouldn't qualify as student loan because it wasn't from the original source. Am I hearing that right? Or no, Barb, like you're, whoop.
It really depends.
Okay.
So you may go to, Bank of America and get a line of credit and use that line of credit to pay off the student loans. The line of credit you have with Bank of America is not a student loan. However, there are certain student loan companies that will allow you to refinance your loans. So you may have 3 or 4 different loans because of, maybe you needed 2 for your undergrad, 2 for your chiropractic school, and then you get to the end, you want to aggregate them together so that you can roll them into a single loan. There are some companies that will allow you to do that. Now, whether they'll offer you better terms or not is a different question. But they would allow you to do that. And in that case, it may retain its character as a student loan. So it really depends upon what it is that you're doing.
Okay. All right. That makes sense. So then another question that just came in from Lee says, can income-based plans be changed to a regular plan if income increases to a point that the income-based payment is way more than the regular payment? And would changing the payment affect the potential forgiveness? That may be too specific to answer, but maybe not.
That's somewhat of a complicated question because it depends on what loan program you're in at the outset. Some of them really, when you start a repayment program, effectively make you choose path A, path B, or path C. And once you've chosen, you can't change it. So assuming that that's the case, then no, you wouldn't be in that position. But one of my questions here would be, is it in your best interest if you can change and lower the payment? Is it in your best interest to do that? Because if you do lower the payment back down, now you're eating way less of the principal, which means that there's more payment, more loan to repay over time, which means that your forgiveness amount will ultimately be higher, assuming you qualify for the forgiveness at the end of the rainbow. So this is another one of those things that you have to understand the full circumstances. There are certain situations where it makes sense, Barbara, as you said you did, to work your tail off, do whatever you need to do, and just pay as much as you possibly can over the course of a relatively short time to pay down the loan balance. One of the things that people tend to lose sight of with these student loans is that even when you're in a situation where, let's say you haven't finished school while the interest is still building, or if you haven't made enough money yet to trigger the repayment, the interest is still building. So most of these loan programs force you to pay down the interest first. Yeah. So the majority of the payment at the outset is the interest. You'll pay very little to the principal. Once you actually get into the principal, you may find that the amount you borrowed initially was about $200,000, but by the time you're actually starting to repay, you may owe $250, $275, even $300. I've seen situations where it's almost increased by 50%. So being able to look at the big picture and understand really where you want to be over the course of the loan repayment program, understand what your income is going to look like, understand what potential you have if you go out and you grow your practice, understand what that's going to do to your lifestyle. Having this out from under you, having this debt burden off your shoulders really does make a very big difference in your quality of life. Because not only do you have one less bill to pay every month, but it also gives you the freedom to stash some cash away, to actually be able to save up for a down payment on a house, to be able to put money away for your kids' college so that maybe their student loans aren't quite as large as yours. It allows you to do a variety of things. So you have to take all of your goals, all of your resources into account when making that decision as to which path you want to go down. And as I said, even if it's a program where they allow you to flip-flop back and forth, you may find that if you do the long-term analysis, and let's say you're 8 years in, you've been doing income-based, your income starts spiking, your chiropractic office is really humming, you're making a lot of money. You may sit back and look at it at that point and say, you know what, I'm making X dollars a year. My lifestyle is such that I really, after paying my taxes and all my bills and everything, it's left me with an extra $30,000 a year. That's less than my income-based loan repayment. I'm going to chunk away more into that loan because I want to get rid of it. And I'm going to use my excess cash to do that. Now, you may look at that money and say, you know what, I have 2 little kids. I want to put it away into their college savings, which would be fine as well. But you have to do that analysis for yourself. You may find that it's not in your best interest to really flip back and forth between the two, even if you have the ability to do so. The lowest payment is not necessarily the best payment.
Yeah. And I think that's true with private lending too, right? Like if you can get a 50, what was it? Like cars used to be like, you had to pay cash for them, right? And then it went, well, you could do 36 months or 60 months. And now I think you can like extend it out for like almost like a mortgage. It's crazy, but that doesn't mean that that's the best thing. Probably not the best thing for your finances.
Yeah,
And
I have seen people get 84-month auto loans, and this is actually a very good example. So I have a client who gets a new car every 3 years, like clockwork. He just likes new cars. And the last loan proposal he got was for an 84-month auto loan. So we ran the Kelley Blue Book to see what his car might be worth in 3 years when he'd likely want to get rid of it. And we ran the amortization to figure out where the loan balance would be. And we figured out in order for him to get into a brand new car in 3 years on an 84-month loan, he would be so far upside down on the loan paperwork, he'd actually have to come out of pocket about $15,000. It was more than 10. It was like 12% of the car value at that time. He would have had to come out of pocket in order to cover so that he could actually get out of that car into a new one. So yes, would the monthly payment have been lower? Absolutely, no question. If you're having a cash flow issue, that low monthly payment's a big deal. But the bigger question in a situation like that is if the cash flow is that big of an issue and you're not going to have an event in the next couple of years that will allow you to put a chunk of money down, the question is, should you be incurring an expense like that by buying a car like that? Or should you be buying a more modest vehicle that you can get away with a lower payment over a shorter loan term? That way in 3 years, you can get into your new vehicle at the same basic cost without having to come out of pocket $10,000, $15,000, $20,000 to do it. It's a similar analysis with the student loans, although by the point where you're repaying the loans, you've already paid for it. You've already gotten the education, it's already outlaid.
yeah.
But the analysis really has to be, in the very short run, what cash flow can I consume with these payments? In the long run, based on my options, what's going to have me coming out of pocket the absolute least when taking into account the amount of the loan repaid, the taxes you have to pay, plus the taxes on the debt forgiveness.
So Jason, one of the things that I saw going around in April, and I see your question and I'm hoping that I'll get to it. If not, I will be sending all of the additional comments and questions you guys put below to Jason. But one of the overreaching things that I see a lot of docs doing is spending a lot of time figuring out who can pay for my loans and how can I get them forgiven. And in my business mind, I think, oh my goodness, what if instead of looking for that, you spent all of those hours of worry and talking to your peers and trying to find someone who pay your loan and just like went into action in your business to generate, 6, 7, 8 figures. Like from the fact that you've been doing this a long time, from whether it's an accounting perspective, an IRS perspective, or loan perspective, what advice do you have about that? Like in terms of, kind of the fact that I pay a whole bunch of taxes, I don't like it, but I certainly like the fact that we make a lot of money. So that's part of the cost of playing, right?
Yeah. So I always, I have clients pretty much every day who say to me, I need my tax bill to be lower. You got to do better and get my tax bill lower.
Yes.
And I
Guilty.
fully agree. I'd love to get the tax bills lower. That's one of my goals is to get those as low as we reasonably can. There comes a point though where you have to look at it and say, you know what, am I going to turn down the opportunity to make X amount of additional dollars, understanding that I'm only going to keep whatever the percentage is. So if you're in California and your effective tax rate is 50% because of the state taxes, federal taxes, let's say you're making $1 million a year, your effective tax rate on your next dollar is 50%. What would you rather have? 100% of zero or 50% of something?
Yes. Yeah.
Look at it. I mean, it's a little bit of a harsh statement in a certain fashion, but these types of things are unfortunately a reality of life. There's the joke, there's only 2 certainties in life, death and taxes. Well, I'm pretty sure that that's a true statement, at least as we stand here today.
Yeah.
And so when applying that, whether it's to student loans or to income taxes, if you have the ability to go out and see that one additional patient, and you have the ability to do those adjustments, and let's say you make $100 by seeing that one additional patient. Let's say you're in the 30% tax bracket and you're in a 10% income-based repayment program. So net at the end of the day, you're going to walk away from that with $60 in your pocket. If you spend an hour of your time and you've gotten that $60 and that's worth it, then I'd say every day you should be doing that. Now, if you look at it and say, well, if I did this other thing, I'd have $80 in my pocket, or I'd have $80 worth of value in some other way, whether it's I really love reading and it would have given me an hour to read this book and that's priceless to me. That's worth at least $100 for that hour. Then you know what? Hey, you've made a life decision there that's the more important piece. And that's terrific. That's terrific. We all get to a point where we look at it and say that next hour of work is just not worth doing. It's just too burdensome. I'd rather do whatever it may be, whatever that thing is that you really prefer. And so I really view it as pragmatically as I can that way, as opposed to looking at it and saying, this is what these people are taking away from me, whether it's the IRS or the company that issued the student loan. Instead of saying, this is what they're taking away from me, I look at it and say, these are the opportunities I'm afforded by doing this. And oh, by the way, I still do get to keep X percentage of this, whether that's 50%, 60%, 70%, I'm walking away with this percentage in my pocket that I would not have had I not spent this hour doing this thing.
That's awesome. And I see, obviously I'm not a fan of a $200,000 student loan, but if that's the price that you have to pay in order to be a chiropractor, in order to change lives, you get to determine how much money you want to make. Time is our inventory, and success isn't a resource that gets used up. We can all be successful. And guess what? I can show you how to do that. Jason can show you how to make sure that your money is going in the places that it's supposed to go in order to keep as much as you possibly can. That's what experts are about, guiding you along this journey in order to make it the very best possible. So I want to honor Jason's time. We're coming up on 40 minutes here. So those of you who have asked, is there going to be a replay? Absolutely. It'll be right here. For those of you from the Women Chiropractors group, I will post a link to it in the group. Please, feel free. I have Jason's email address up there. I will put it in the comments below as well. Just remember to be respectful of him. I'll ask him for anyone who's not being. And Jason, thank you. I really, really appreciate your time. Thanks for all of the really relevant information. I appreciate, so the only thing we didn't talk about are these nonprofit groups who say, come work for us and your loan will get forgiven. I guess that's a big question.
Yeah. So
now that we're almost winding up.
Yeah, so that's the public service loan forgiveness is effectively what they're relying upon. So there are loan programs out there where if you are in a public service type job, so whether that's you're working for a government agency or you're working for a nonprofit, as long as it's a qualified nonprofit, if you have a certain number of years of service with them, then you can get your debt forgiven. And that can be tax exempt, okay? It can be excluded from your income. Now, the thing to keep in mind is, once again, understanding the fine print. Is the loan you have, does it qualify? What you are doing for the nonprofit and the nonprofit's activities, do they qualify? Assuming the answers to those are yes, and you meet the service requirement, then you're in good shape. Then it should work. But once again, even then, you're talking about a lot of years of service. So you have to do a long-term overall viewpoint. People working for nonprofits tend to make less money than people in private practice. So if you have the ability to make $150,000 or $200,000 a year in private practice, and you could go work for the nonprofit and they're going to pay you $50,000 or $75,000 a year, you have to make the determination as to, based on the size of your loan and what you have, where you end up financially at the end of the rainbow. And everyone's circumstance is going to be different. So there are ways that this can work. However, what I will tell you is that you can't be working in public practice in a chiropractic office and have your loan forgiven tax-free just by association with a nonprofit. You do need to meet the service requirements of working for the nonprofit. And I believe, and I haven't looked at this requirement specifically, but I believe you actually need to be an employee of the nonprofit in order for this to qualify. I'm almost certain.
So Jason, all of that though, the first requirement is, what do your loan documents say, right? Because they set the stage for, can you even do this? It's kind of like, as a chiropractor, maybe in school, you learned how to do acupuncture. Well, if the state that you're going to, even if you have those skills, if the state you're going to says, no, we don't allow a chiropractor to do acupuncture, it doesn't matter if you have that training because the state law trumps it. And so your loan documents that you signed for that student loan are the law of the land, right? They're the law, they're the rule that is going to apply to if you decide to do a PSSLF, right? Public Service Loan Forgiveness thing, right?
Right.
And also Jason makes a really good point that you don't get to be in both worlds. Like you don't get to have a practice that you're like basically like moonlighting and also say, oh, no, forgive my loans because I'm doing this thing part-time. Because I have seen several posts about that. Like, well, I'm doing the public service thing part-time, so they're going to forgive my loan, but I'm also in practice over here. And that like didn't sound right to begin with. And it doesn't sound like it probably is. So here's the deal, all of you. Your comments are indicating this has been incredibly helpful. And I'm thankful for Jason laying it out for us. Here's the deal. Get specific answers about your situation. And I would encourage you, yes, like this is the guy that I would go to. This is the guy I do go to. And you've seen clients that have posted their name below saying, yeah, Jason's the bomb and he's my accountant too. But please don't take a general answer for your situation. Your future is more important than a generic response. So reach out to Jason, be mindful of his time. If you don't have an accountant who regularly lets you know, like, hey, I know how I can help you in this way. And like when Jason does my taxes, I literally get, and I'll say I'm probably not the best client for sure. I do refer a lot, but I'm probably not the best client. Like a stack of like a workbook that's like probably this deep of questions that the firm asks, because as chiropractors, we don't know all of the things for deductions. And even according to Jason, it changes all the time. So make sure that you're working with somebody who knows a lot more, like I'm talking exponentially more than you do about tax code. So you can keep as much money as you possibly can based on your income. And always, always, always work to your optimum potential. Integrity isn't just about telling the truth. Integrity is also, am I giving it my all in what I do? Am I obsessed with my life to such a degree that I'm living to my optimum potential? All right. So thank you all very much, Jason. I'm sorry that we went way over the 30 minutes that I told you we would. So thank you so much. God bless you all. Jason, thanks so much. And we'll catch you all on the flip side. Thanks a lot. Bye-bye.